Good afternoon and welcome to the May 6th Century Management Market Update. Our first slide shows basically our summary of what we hope to cover in this next 20 to 30 minutes. First of all, when we look at the market, we believe the market as represented by the S&P or the Russell 3000 growth indexes are in a very expensive zone. The market has basically priced in a lot of the potential optimism in an economic recovery. And at this level, the S&P 500 has considerable risk to the downside if history or valuation metrics serve as a guide. While some of the market appear to be overvalued, there are other sectors that are undervalued. So let's start with the overvalued sector, and we'll show you in slides how that works. The most overvalued sectors in the market today are technology, consumer discretionary, and communications. Other sectors that look to have been largely ignored or haven't moved up along with the other indices are the industrial section, the financial sector, and especially the energy sector. We believe that the best representative of our type of stocks is the Russell 3000, which is 1,000 large companies and 2,000 small companies. And that is more representative of the type of companies that have been ignored, have been not as valued, and are probably cheaper relative to everything else. We will continue to look for companies that fit those descriptions. And now, Scott, if you want to take over here and walk us through the rest of the slides that we have today.
Sure, thank you. Okay, so let's take a look at what Arnold has referred to as the market. That'll be the S&P 500, and then we're going to drill down into some of the value and growth indexes along the way. But let's start to get an idea of where we're at in the marketplace with studying the PE ratios of the S&P 500 index. And you can see at the top of the chart here that as of April 30th, which was Thursday, the S&P 500 had a PE of 19.8. Now its 10-year average has been 17.9. The reason we're using a 10-year average is because this is a period of time in which interest rates have been lower and coming down relative to times past. So we feel it's a interest rate adjusted, it's a very comparable period. And we can see right now that the S&P 500 is selling at about 10% above its 10-year average PE. So now let's and so we would consider this market to be above its fair value, the S&P to be above its fair value. So now let's drill down into a few of the sectors to see what's really been moving the S&P. The sector that's been moving this broad market index the most has been information technology, the tech sector. And on April 30th, it had a PE for this sector of 24.6. Its 10-year average has been a little over 18. So just compared to itself, this information technology sector within the S&P is selling at about 30% above its 10-year average. Now you can see the high was 28.9, so there's still some upside. But if you look at the low, it's about 50% down from here, okay? Now, if we take a look at consumer discretionary, 25.9 was the PE on April 30th. Also well above its 10-year average at almost 28%. It too has roughly 50% to the downside. Still a little bit of upside, but the reward risk is really inverted. Then the communication sector is also selling well above its average, about 22%. Now the communication sector is no longer just AT&T and Verizon. This now also includes stocks that used to be categorized as tech, but now are in the communication sectors. Google, Facebook would be in here. And so it too is above its average. Now, these sectors, when you break out a growth index or you see what gets categorized in the growth category, these sectors of the market come up. Now, if you look at the sectors of the market that have been trading below their 10-year average, to no surprise, it's energy with a PE of 18.2, selling at 28% below its 10-year average PE ratio. Financials, selling at 11.4 PE, 22% below its 10-year average. And then the industrials at 16.1, which is selling 8.5% below its value. So these sectors are the more heavily weighted sectors and lead the way when you talk about value-based indexes. So you can see what's been driving the market: tech, consumer discretionary, and communications, and kind of what's pulled against it. Although in the S&P, energy is the lowest weighted that it's been going back for decades now. So this doesn't have, the energy sector doesn't really have too much of a negative impact on the S&P just due to its weighting. But this gives you an idea of what sectors of the market are cheap and expensive that make up the whole. So now let's go to our next chart. And we want to take a look at just a couple of those sectors that were really above the average and really below the average, just for using another ratio, and to give you another graphic or visual here. And this is the tech sector. It's the tech sector within the S&P, and it goes back to 1990. This time we're going back beyond our 10 years that we just showed you. And we're just using the price to sales ratio of the S&P tech sector divided by the price to sales ratio of the S&P, just to see where that sector comes in from a valuation standpoint. And you can see today, the tech sector relative to itself is as high as it's been in a few decades. You have to go back to the last 6 months of the 99, 2000 kind of tech bubble to see when that sector was higher valued relative to where it is today. If we look at the consumer discretionary sector, while not at the peak, it's just 11% away from the peak. And then looking back, you can see this is pretty high relative to history. Now, when you're looking at these pink bars, these vertical pink bars, these represent recessionary periods. But you can see the consumer discretionary sector also very fully valued. On the energy sector, going on the downside here, you can see that it's about as cheap, while off its rock bottom price that was on March 18th of this year, you can see it's the cheapest it's been in decades. For this one, we're using a price to book value ratio. On the financial sector, also using a price to book value ratio, you can see, while not at the extreme low of 2009, it's in that bottom zone, and clearly at a very discounted price, at a bargain zone that we believe, if you look back for decades. And then on the industrial sector, it is the lowest it's been in decades, even lower than the bottom of 2009 and in 1998, when the industrials were kind of left behind. So this gives you a visual of some of the markets that we said, tech and consumer, that are overvalued, and energy, industrial, and financials that are undervalued. So now let's drill down a little bit deeper and take a look at growth versus value. Because we just talked about these sectors, some are more growth orientated, some are more value orientated. And to do this, we're going to use the Russell indexes. So just like Standard & Poor's makes the S&P 500 or the Dow Jones makes the Dow 30, Russell is another organization that has various indices. And they parse out growth and value. To be included in the growth index, this is 3,000 companies, and they are typically companies that are growing a little bit faster. The value index is made up of companies that are growing maybe not quite as fast, but they're selling at a cheaper multiple of their book value. And that's how the constituents are parsed out in these two indexes. So we can see on April 30th that the PE of the growth index was at 32. The 10-year average has been 22.6. So if we just parsed out the growth stocks, the 3,000 largest growth stocks, they're 41% above the 10-year average PE. Now you can see 33.8 is the high, and here it is at 32. This is, again, a 10-year average. And so while there's upside, not too much. When we look at the low multiple, you can see that's a big drop if it were to even get close to that. Now looking at the value index, its PE is 16. The 10-year average is 16.9. So it's actually selling at 5.3 below its average. So you can see if you start to parse out the growth stocks versus the value stocks, one is very expensive and one is looking like a bargain, both on an absolute basis and on a relative basis. So now let's take a little bit longer history of this growth versus value using the same Russell 3000 growth index and the Russell 3000 value index. On this chart, you're looking, the growth index is represented by the gold line, and the Russell 3000 value index is represented by the blue line. And we have them starting at the same point in time in 1995. And what you can see now is that for the last 5 years, well, actually, let me start back here. If we go back to 1997, 98, you can see that the growth stocks really started to outperform the value stocks. Value kind of flatlined in the last 5 years of the 90s, and the growth stocks really went parabolic. Matter of fact, at the peak here, which was on March 9th of 2000, the growth index was 73% above the value index. So huge outperformance here. Then when the early 2000s happened in the market, the S&P went down for 3 years. Those stocks came down, hit a low in 2002, but you can see it was around that time that the value stocks started to really outperform. And they did so all the way to 07, and it had a maximum difference of 48% outperformance. That maximum was on August 8th of 06. Then we all remember the 08-09 recession. The stocks came down, and then from that point, they all kind of recovered, and they went up relatively together as far as valuation is concerned. But starting about middle to late 2014, certainly beginning of 2015, growth started to really outperform its value counterpart. And as I started off saying on this slide, value kind of flatlined here for about 5 years while growth was going up. Now, at the peak difference so far, which actually happened on May 5th, is the peak difference is 62% outperformance of growth over value. But you can see value has really lagged here. This is one of the reasons, and we're going to keep coming back to this, that the value, because it hasn't really gone anywhere to speak of in the last 5 years, is undervalued, and where the growth stocks and sectors are more overvalued just because it's run a lot more. Let's take another viewpoint of growth versus value. And what you're looking at here on this chart these are bars that represent 10-year periods of time. The blue bars represent decades when, or 10-year periods when value outperformed growth, and the red bars represent periods of time when growth outperformed value. So let's take a look at this, just to give you an idea, make sure everybody's dialed in here. This first blue bar says 1950. So this means for the 10 years ending in 1950, so from 1940 to 1950, value stocks outperformed growth. The next one says 1984. So that means from 1974 to 1984, value stocks outperformed growth stocks for that 10-year period of time. Conversely, this largest differential is in 1939. This means that growth stocks outperformed value stocks from 1929 to 1939. So you get the idea. When we put it all together, there from 1937 to 2019, there have been 83 periods of time. There's 83 bars on this chart. And value after 10 years has only underperformed 15 out of those 83 years, which is about 82%. So that means value has outperformed growth 82% of the time once you've put together 10-year periods. Now, while these are ending in calendar years, statistically, it would come out the same even if you did this with a starting period of every single month. You could start at 1926 and say, okay, every single month begins a new 10-year period, and the results would basically be the same. Now, what's interesting is that in the 15 periods where growth outperformed value, 9 of them, or 60% of them, have occurred in these years here. The 10 years ending in 2011, the 10 years that ended in 2012, the 10 years that ended 2019. So most of them have happened here recently. And again, remembering the charts that we've just shown you, that value has underperformed growth, as we just saw on the previous chart. Well, this shows you in 10-year increments that is also true. One of the main reasons this has happened is that growth stocks tend to do a little better in a declining or lower interest rate environments and a lower inflationary environment. The same reason occurred coming after the Depression, when you have the 10-year period ending 1937, or the 10 years ending 1938, or 10 years ending 1939. That was a period of lowering interest rates and lower inflation. So growth has definitely had a good run over this last 10-year period of time. So now I'm going to turn this back over to Arnold, and he's going to start to share with you. So where do we go from here?
Okay, thanks, Scott. I think what Scott demonstrated by these charts is to show you that value normally outperforms 85% of the time. But in this unusual 10-year periods, there are more periods where value underperformed growth than any other period in history. And you can see that by the different indexes that we're going to show you right here on page 12. So the first line is the Russell 3000 Value Index. And what we're doing is we're just taking the consensus estimate in earnings, what Wall Street believes the earnings are going to be of the Russell 3000. So we take the 7383, we multiply it times the average PE for this index, which has been 1696 or 17. We multiply it, we come to 1252. So when we look at the closing price of April 30th, that is, the projection is that it would go to 1252, but it's at 1419, which means it's 11% above where theoretically it should be. Now let's do the same exercise with the S&P 500. The S&P 500 is projected to earn about $133. It's a little higher than other things. We have a little lower number, but we're going to use the consensus number of 133. We're going to multiply it times the average PE of the 10-year. That would give us a value of 2384. The market is 2912 as of this last Thursday. So that gives us a minus 18. Now we look at the Russell 3000 growth index, and we see that it's going to earn about $50. Multiplied times the average PE of the last 10 years, 22. We come up with 1143. It's now at 1388, which means it's down 17%. So what all of these indexes show is that they're all pretty much fully priced and a bit overvalued. The value has less overvalued because it's going to decline 11% versus 18 and 17. But none of them are cheap, but certain ones are cheaper than others based on today's fundamentals. Now let's take a look into the future. A lot of people are saying, well, you can write off this year, but next year when everything gets back together, everything will be much better. So let's take the consensus that the Wall Street has given us for 2021. Now, bear in mind, we're into 2020, so we're looking ahead 20 months. But let's assume that we take this analysis that once the economy comes back, earnings come back, not as high as they were, but certainly much higher. Let's see what the market shows. So if we take the Russell 3000, the same thing, we take the $96, which is projected, times the average PE ratio, gets to 1,600. The closing price is at 14. So based on the Russell 3000 value, you theoretically, based on next year's earnings, could go up 14%. If we take the S&P 500, you got $163 times the average PE of 10. You get to 2,932. We're at 2,912. So it has very little bit to go up. Now, bear in mind, we're not talking about this year, we're talking about next year. And now we take the Russell Growth, which has got $60.80 projected in 2021, times the average PE, gets to 1376. We're at 1388, which means it actually goes down 0.90%. So you can see, even when we look into next year, there's only one area that you might be able to make money in, and that is in the Russell 3000 type of index. And that is the 2000 value type of stocks, and also the small cap stocks, which are part of that index. And that has a 14%. But now let's just show you how far this market is looking ahead. And now we're going to act, and this is a real bullish assumption, which we don't subscribe to, but we're telling you what the S&P could do based on what everybody thought before the coronavirus was started. So in the beginning of this year, looking into 2021, all the analysts believed that,
Or actually, Arnold, that was looking into 2020, just for this year.
yes, I'm sorry, that's right. They were looking into 2020 in 2019, and they felt that the S&P could earn $174. Now, what they're projecting, as I showed you in the last chart, is into the 160s. But here is the most bullish ways to look at it, and to say, let's assume the coronavirus didn't happen. We're into 2019, we're looking into 2020, and it's going to earn $174, the S&P. Now, we don't really believe that's going to happen. I don't think too many people do, but let's just assume that's it. We want to show you, even if you look at the most maximum optimistic projection, there's not a whole lot left in the market if you're in the S&P. But let's start off with the Russell 3000 value. The basic projection at that time was 112. Average PE is 1696. Gives you a basis of going to 1908. We were at 1419. So that means the Russell 3000 value could go up to 34%. That is assuming the most optimistic. Now we take the S&P. This is as if there was no coronavirus. We just lost a year in earnings. Now we're looking into 2021, 1790 times PE gets you to 3,100. We're at 2,900. So it only gives you an upside of 6.94. Now, I want to make this very important for those people who have a lot of money in the S&P. Probably the most overvalued indexes is the Russell 3000, all the growth stocks, and the S&P 500. So if you're going to be in the market, it would be better to go into individual stocks like the Russell 3000 equivalent, or if you wanted to be in an index, you could be in the Russell 3000 index, which has a lot less downside and a lot more upside if things turn out well. But let's finish up with the Russell 3000. Projected based on the optimistic was 59 times 2264 gets you to 1358. It's 1388. So that means even under the most optimistic scenario, which we can't even imagine because it's like the coronavirus didn't even exist, and you would have a loss of 2.18%. So if you summarize it, the value stocks offer the most under any scenario. The S&P is in the middle, and probably the most overvalued is the Russell 3 Grows, as Scott has shown you in the other chart.
And Arnold, it looks like when you and I have talked and we've had our research meetings, it really looks like a lot of folks in the market, certainly from the growth side or even the S&P, are really looking over the valley here.
Yeah, and I want to make a point. It's kind of like if we were on a hike and we were at one peak, and then there's a deep valley in between, and then you see the other peak and you look over and say, geez, that looks like a pretty nice place to be. And that's what the market is doing. It's forgetting about this year's poor earnings. It's looking ahead into next year. But what most people forget is we haven't gone through the valley yet. We have gone and looked over the valley, but we haven't gone through it. And I believe when the market does go through it, it could suggest a lot lower prices. But anyway, let's take this index by itself. Now we're going to show you the S&P 500 index. It's a price to sales ratio. Now, people ask me when I'm using indexes, why do I use a price to sale ratio? The reason I use the price to sale ratio is because it fluctuates a lot less, and there's not a lot of manipulating you can do with the sales. Once you show $1 of sales, there's a lot of ways you can manipulate the earnings to make them look a little better than they are. But a dollar in sales is a dollar in sales. And if you go through the last two recessions, one of them, the sales actually stayed up and moved up a few percent. And in one of them, the sales went down 10%. So when you use a price to sales, you have a much better chance of getting an accurate reading than if you're using a price to earnings. Price to earnings in normal times is okay, but on a longer term basis, the price to sales is a better gauge. And we wrote an article, if any of you are interested, in the 2000 bubble where we made a projection on the price to sales, and we showed that, we didn't think there would be a lot of return in the next 10 years, and using the price to sales, it proved to be pretty accurate. So now let's look at the price to sales. What we're saying is, what is the dollar willing to pay for every dollar in sales in the S&P? And you can see the median or the average is 165. So if you take and we're using the last 14 years because of the interest rates, which is comparable. So when you look at the last 13 or 14 years, the average or the median has been 165. In this last market drop, we went from 243 to about 161, which means as severe as that decline was, we only got to the average price. A lot of people thought that the stocks were really cheap then, and they were, and we were able to pick up some very good bargains at that time. But even the ones that we really wanted, we didn't get to buy a full position because they weren't quite cheap enough. But now it's rallied back up, halfway back up. And so you can see that it's not even at the average, it's a little bit above average. Now,
that's at 2.04 right now.
Okay, so we're at 2.04. Now let's take a look at the chart in the left-hand corner. And you can see that at the bottom, which we showed here on 0.68, that was in the bottom of 209, the price to sales got into the range of 0.68. The high range was 0.86, and it only stayed there 66 days out of 3,000. So you know that at this level, it doesn't spend too much. So it only spent 2% of the time, which means 98% of the time, if it ever gets that cheap, it's going to be higher. Now let's move up the ladder a little bit and say we pick 121, 1.21 to 138. That means 68 to 80% of the time, it's going to be higher. So we've given you this chart to show you. Now let's go to the top of the range from 226 to 243. In the last 14 years, that's 3,356 trading days, it only spent 127 days at that peak. And that's only 3.8% of the time. Now we're at that halfway in between. If it goes back to 243, that means we're going to be in extremely overvalued territory. And just to show you how overvalued it is, we're actually showing you on page 16, not only the last 14 years, but the last 30 years, 26 to 30 years. And you can see at the tech bubble, which is in the 99, 2000, that's the other peak here, that peak right there. We are as high, if not higher, than we were in the year 2000. So when you look at the fact that we reached this level and we're almost halfway back, even if the market goes up a few hundred points, it's going to put you into overvalued territory. And that's the most overvalued in 26 to 30 years. So that, again, is an indication that this market did not get quite as cheap as a lot of people thought it did. Now let's go to page 17. We basically are showing you the same thing, except that we show you the Russell 3000, which are
3,000 value.
stocks. Now, as you can see, the peak was 177. The median is 133. That's the midpoint. And we, on 12/24/18, we got the 129. At the 323, we got to 9.96. Now, when you look at 0.96, that's below the median, where the other S&P was above the median. So you can see that this index is a lot cheaper when you compare it to the S&P. And when you get into the, let's go to the bottom here, which was in 2009, you can see that it spends only 1% of the time. But even at the one-time sales, which it hit, 67 to 80% of the time it's going to go higher. So the value indexes, the median, the Russell 3000 did start to approach a very reasonable level of evaluation. And if it went down a little bit more, if it went down to the 0.87 to 1, which is just a little bit below the March 23rd, then you would be at a position where 80% of the time it would go higher. So relative to every other index, we feel the Russell 3000 represents our portfolio better than any other index. And our portfolio also represents those three major sectors that we showed you were the most undervalued. So from a valuation standpoint, even though the Russell 3000 is not at the absolute lows, it did get into a zone where it was very close. And one of the main reasons it's undervalued relative to the other one is because they didn't go up as much. And so that's another reason why you have less risk and a little more opportunity. Now, Scott, why don't you walk us through that S&P 500 index from 68 to the present?
Great. Okay, so the chart you're looking at now, the blue line is as Arnold just said, is the S&P 500 price from 1968 through Thursday, April 30th, 2020. And a couple of interesting points we just want to share with you. So if we take a look at the bottom of 09, March 9th of 09, and go all the way up to the peak that we just had February 19th of this year, the S&P had a 400% increase. And that's been fantastic, right? And so that's one of the reasons it's had a lot of attention is for 10 years, it's, with a few side steps, it's more or less gone straight up. But the same was also true back from 1990 to 2000. It went up 410%. But look what happened to the S&P after that. And this is what we really want to bring to your attention when we talk about the valuations that we just did. That for this 11.75 year period of time that ended in September of 2011, after 11.75 years, the S&P had delivered a total loss of 4.8%, or an annualized loss of minus 0.42%. And this includes the dividends. So if you were just buying and holding the S&P, like so often we hear now in the financial media, just buy and hold the S&P because it's gone up for 10 years. There's a lot of people that forget about this particular period of time where from 2000 down to the bottom of 2002, the S&P dropped 48%. Then it rallied up to 07. Then for about a year and a half, it came down, and bottoming in March of 09. That went down 56%. And so if you were to recognize the values, like Arnold just showed, on a price to sales ratio, where you could see you're getting into the upper zones of valuation, let's just assume we don't call the exact top, but you could say in those upper zones, you have dollar cost average out of the index or individual stocks that are at the equivalent upper valuations. You can save yourself a lot of pain. And then on the other side, when it gets into the bargain zones, you can start dollar cost averaging your way back in. And so while we hear a lot about it's hard to time the market, and yes, that's true, but if you're timing and looking at the valuations, it makes it a little easier to play these types of price movements. But we just thought it was important to share with you that while we've had this 10-year move of 400%, it was similar to the one in the 1990s, and then reflected in a total loss while the valuations were trying to catch up. So let's take a look at why that happens. This next chart, we're going to take a look at profits versus the stock price of, say, the S&P. So the blue line, once again, is the price of the S&P, and the gold or yellow line is the after-tax U.S. corporate profits, so our earnings. And what we can see is that in the late 90s, the price of the S&P was going up, but earnings were more or less flat. So what happened? This was the momentum crowd. This was the euphoria. This is going up based on emotion, or people are getting into pushing the price up, just buying the index or the components of the index just because they're going up, but it wasn't justified based on the fundamentals. And so what happened? Eventually, the price of the index came down to meet the earnings. And then we saw it again, the price, as represented by higher PE ratios that we showed you in the early part of this presentation, got, again, a much higher valuation relative to the fundamental after-tax corporate earnings. Then we saw, after coming off the 09 decline, for the next few years, the earnings justified a much higher stock price, and eventually the stock price took off. And again, if we're looking over the last 5-6 years, you can see that the S&P 500's price has gone up materially higher than the rate that the earnings have grown. Matter of fact, last year, the earnings really didn't grow on the S&P. They were largely flat. The wonderful appreciation the S&P had last year was mostly due to the PE multiple expanding because of the lowering of the interest rates. So the PEs expanded about 26-27% last year, and that was by and large, the S&P return. It was from multiple expansion. It wasn't justified by earnings increases. And now we just showed you, as Arnold said, where do we go from here? The consensus for earnings has declined because of the virus. So as this shows, at some point, the price comes down to meet the earnings. It did it here, it did it here, and undoubtedly, either the price is going to come down or the earnings have to go up to kind of square the value. And most likely, the price is probably going to come down more than the earnings going up, at least in the shorter term.
If I can add something, Scott.
Sure.
If you look at the last circle and you look at how low the index went, but then if you look at the earnings line is around the 1900 to 2000. So it's very possible, if history is any guide, when you look at the evaluation, that either the earnings are going to have to go up very dramatically, or the market is going to be coming down to meet those earnings, and it could be in between. But we're looking at the 1900 to 2000 on the S&P, And in March of 23rd, it got there, but not quite as low as it was there. So that's to keep in mind that there's still a potential risk in this market, especially in the S&P 500.
Yeah, so to test those March lows, there's probably 21, 22% downside on the S&P, but to get down to where it would actually match those earnings, just do the math there, that's about a 34% decline. So now, just using history as a guide, if we, what is the likelihood of testing these March lows? Well, we went back and looked from 1950 to present that there were 18 bear markets. Now, technically, a bear market is a decline of 20% or more, but there were a few that were declines from 1950 to present that were like 19 and 3/4 or 19.8. And so we thought we'd include any decline of 19% or greater. And what we see is that there were 18 periods since 1950 where the market, the S&P, if you will, dropped 19% or greater. And importantly, 15 of those 18 bear markets tested the low, that initial low, like tested that initial March 23rd low that we saw. Now, 4 of them actually not only tested that low, but within 3 to 10 months, they went lower. But 11 of them got pretty close to that low, didn't quite make a new one. It was still painful, and then it eventually took off. And then there were 3 that didn't really test that initial low. It just kept going. So when we look at 15 out of the 18 markets to test the low, that suggests that 83% of the time since 1950, there's a possibility to test the low. It's something that weighs on our mind. It's something that we think about, and certainly something that we shouldn't ignore. Now, just to continue on with history just a little bit, as a guide to the volatility that could happen here, we can just take a look at 2 periods of time that we've already discussed on these other charts. One was from the peak of September of 2000 to the bottom of 2002. You can see that the market had this decline, the S&P had this decline of 48.9%. And you can see on this line graph, it was going down, it rallied up, it went down, it rallied up, it went down, it rallied up, it went down. And look at the significance of these declines, down 27%, and then it rallied up 19%, and then for another 4 months, it went down 26%, and then it rallied up again 22%, and then finally hit that final blow-off low for about 6 months, it went down 33%. So a lot of volatility here, which is not something that you should be afraid of, but it's recognizing these valuations. Think about that price to sales chart. It's in the expensive zone, it's in the midpoint, it's in the bargain zone, and recognizing the valuations at this point to either add to the portfolio or to raise some cash. And then the same volatility we saw in that year-and-a-half decline from 2007 to 09, when the market went down 56%. You can see the volatility down 18, up 12, down 47, up 25, down 27. So again, recognizing these values is what we're looking to do when managing the overall portfolio. But we just wanted to give you this perspective on valuations and the possibility of retesting a low. And so now I'm going to turn it over to Arnold to kind of wrap it up and give you our final thoughts.
Thank you, Scott. So basically, what we attempted to do by going through the different things is we showed that when you speak about the stock market, most people think about the S&P because it's been the most successful, it's given the highest return, and it's been a wonderful place to be in the last 10 or 12 years. However, the more popular it became and the more it performed, the more people were attracted to it. And so more and more money went into the S&P, and a lot of it didn't go into the other areas. That's why value has underperformed, whether you measured in the Russell 3000 value or the Russell 2000 value. They're all a lot lower and they have a lot less risk. Not necessarily because they were better stocks, but because they didn't go up as much, so they're not obviously that far above their lows. So the thing that we want to point out for those of you who have money in the market, who have it in S&P index, we feel there's very little opportunity there with a lot of risk. If you wanted to stay in index, you can switch to some of the other indexes that while they would still go down, they represent a greater percentage of the value. And that is also the areas where we have been concentrating. That's where our portfolio is. We mentioned to you that the technology, consumer discretionary communication is the most overvalued part of those markets. The cheapest are the industrial, financial, and energy. And so the index that represents the most of those cheap areas and the kind of stocks we own is the Russell 3000. And we believe that in the market today, even those risk in all of them, this is where the greatest potential is. And it's going to take some patience. We're waiting with cash. We have a list of stocks that meet those qualifications. And when the market moves up and down, we'll be taking advantage of it. And so we just wanted to bring that perspective. And if any of you have any questions, please don't hesitate to call or write us, and we'd be happy to try to answer your question. Thank you for joining us on this call.
Thank you.